I think if you're a SpotGamma subscriber, as you all are, you've read our notes recently about the compression in the VIX and the compression in implied volatility relative to realized. And I want to just walk you through my thinking here, and I don't know, just to see what you guys think. It was something I've been pondering for a while. It does wade a little more into the macro, which I think that will draw some different critiques. But essentially what you're looking at on this chart, we've posted this so you should be familiar with it, is you have the S&P 500 here, right, in green. And then there's two lines here. You have implied volatility in white. So you can almost think of this as like the VIX, right, in white. So what is the 1 month implied volatility? What are traders expecting in terms of movement in the S&P 500? And when I snapped this picture, it was in 18. And as you can see, that recently went under this orange line. So the orange line is historical 1 month volatility, right? And historical implied vol is at 17. So generally, implied volatility, if you want to set a barometer for what implied volatility should be, if you look at realized volatility or what volatility has been doing, that should be a decent basis, right? Now, yes, were there big events in the past? Did the Fed just happen? Did an election just happen? You got to handicap a little bit, but let's just say it's a fairly normal environment. And clearly, if you looked at realized vol in like Tesla and it's a 50, well, you can expect implied is going to be really near 50. Whereas if you looked at Coca-Cola and realized vol in Coca-Cola is probably like a 10, then you go, okay, so implied vol should be, I don't know, like a 10, right? So you can weigh these. It's not, it's not an exact science, but it's a good barometer. And so what happens is, what we've noticed is near these tops, right, you get what I've been calling compression between these two. And what I mean by that is you could see that implied vol comes way down. This is the white line. And then with that, realized vol comes down. And so what's happening is we rally, and as we rally, implied vol fades, right? Because generally put prices decline, and then we kind of pin or we digest up in these areas, right? We hit these call wall levels, right? And the market suddenly stalls out, implied volatility gets sucked out of the market, traders sell vol, realized vol collapses, and then suddenly what you end up with are these situations where realized vol is above implied. And why that is significant is, and I've talked about this in the notes, it was linked in the notes this morning, is that the only two ways that implied could be under realized is either something has changed in the market such that traders now say, look, the risks that were in the market are gone, right? That's one way implied should be under realized. Or the second one is we kind of just oversold volatility, right? Like we just love selling calls. We love selling puts. We love selling straddles. We want to sell D0 DT. We want to crush vol. Let's crush it. And then it just pushes it too low. And my argument is that essentially what we have is the situation that we have is the Fed, in interest rate policy is really what's driving a lot of the macro angst, right? And I think you could tie that to low levels of liquidity and the like. And so the situation is that until the Fed comes out and says, hey, no more rate hikes, this is where we bleed in the macro a little bit. Until we have, hey, we're pausing, then we're going to continue to have this anxiety around, well, what are the hikes going to be? Are there going to be 50? Is it going to be 25? Oh, the CPI was hot. Oh, the jobless numbers were hot. Oh, no, like all these other macro things that just all have implications on what the Fed is going to do in terms of rates. Now, we may have a recession next year and then we get more volatility because of that. And I'm not, a year from now, who knows, but I'm looking in the next several weeks and saying, look, the FOMC is on the 1st. And what happened yesterday, Bullard came out and said, oh, no, I think that maybe rates should be higher, higher for longer is this theme now. And that I think was the real catalyst to kind of shock the market yesterday and drop us 2%. It really squashed that bullish narrative. And so the point here is that we have not cleared out the primary risk, which is rates, right? And that's the number one concern right now. We may hit a recession. That's macro stuff. I'm not talking about that, but the risk is not cleared. And so in my view, implied volatility has just gotten too squashed. And so what I thought was interesting about this, and this is a food for thought thing, you can go chat with your friendly, macro Twitter person or whatever. This is the relationship between the rates. So this is the 10-year rate. And you can see that as those rates spike, the market makes lows, right? This relationship is very clearly inverted right now. And market is very focused on this. And why is that? Well, obviously, as you continue to increase interest rates, then the fair value, I think, of the S&P, if you can get risk-free 5, 6, 7, 8% in treasury bills, then why are you really going to want to own equities, right? Or should equities be valued where they are yesterday or last week or last year? A lot of people, I think, would argue no. And so what I kind of picked up on here, which I just think is interesting food for thought, is that this is the blue line is the price to earnings ratio in the S&P 500. You can see that under 20 is where we were. And if you look longer term, I think the long-term average is in this 15 to kind of 20 area. And so we got very rich in terms of going into the COVID crash, right? And those obviously got reset. And then we had all this giant liquidity injection and P's got crazy. And again, I apologize for digging so much into the macro here. I just think this is super interesting. So, if we look at where PEs are now, they're kind of back in the longer term range a bit. And I think a lot of people feel like, well, if there's a recession or if rates are even going to go higher, then this PE number probably has to come down. And that gives us more of this S&P into the 3,400-ish kind of pre-COVID area, right? I think actually 3,400 is right here. And so if we suddenly tank down to that area, then you could start to go, well, it doesn't really matter how much more the Fed is going to do because equities have a great valuation now. They're trading at a 15 PE. I'm much more interested in owning equities here. And maybe that speaks better to lower volatility. But the point here again is that as rates go higher, valuations decline. And I think what is happening then is that we get short cover rallies and spurts based on what current rates are and valuations, right? And then what happens is rates go even higher, and then the valuation level is now, instead of being at 4,600, now we're kind of at more 4,300, and now we're maybe at 4,000. And if rates go even higher, then maybe the peak sort of PE P pops its head above 18 again if we're at like 3,800, right? This is sort of just a food for thought thing. But basically the point here is that I think that there's big sellers that are basing off these valuations. And so when we get a short cover rally and we get this huge move higher, that rally stalls out, generate these call walls, we grind because sellers start showing up, call sellers start coming in. And, I don't want to own equities at 20 plus PE anymore. So I'm really willing to sell this a lot harder. So you get the short cover rally up in these guys who are maybe selling on more fundamental bases or off these fundamental triggers, and spreads collapse, right? Bid-ask spreads collapse. The fuel to run these rallies dries up because there's sellers absorbing those rallies. Then you get the implied volatility collapsing relative to realized volatility. And then suddenly what happens is there's not really anywhere for vol to go except for down, right? Because those sellers are sitting on top of this thing. And so, it's just this kind of interesting, again, food for thought experiment. But the key is that we flagged this Monday saying, look, this just seems like implied vol is now too cheap. And again, we thought that this was going to hold off to next week. I was maybe at a fault of getting a little too cute with my timing, but this seems to consistently be the metric. Now on the first, if the Fed says, look, we're done raising, then implied vol is probably going to tank pretty hard, under realized, at which point you maybe don't want to pay attention to the same metric, right? We're probably going to get a more sustained rally off of that. But, Fed's like, look, I'm going to wait and see, or, the terminal rate moves higher, whatever it may be, there's still that rate anxiety. Then I think you really still want to hedge yourself in terms of long equities anytime you see certainly implied volatility get under this 18, especially if it's under realized. Now, the same thing doesn't hold true, obviously, if realized is up here, right? Because that's a whole different level of volatility if you're talking 30 implied volatility or 30 VIX, right? And what I'm specifically talking about is if implied vol is under this 18 level. Because if you think about implied volatility at 16, that's basically forecasting 1% moves, or realize that 16 is 1% daily moves, which is very easy to get in these markets. And so that's what this lower bound really is. Like, do you think we're going to stop getting 1% moves in the S&P 500 anytime soon? It's very hard to believe that based on low liquidity, all these different metrics of uncertainty and the like. At any rate, I hope that kind of lays out this thesis for y'all. I thought it may be interesting just to kind of step into a little bit of a view in terms of this, macro analysis of fair value and things like that, and how that realized and implied volatility spread, when it really compresses, can be a very interesting signal to watch.